3 weeks ago, something happened that should have stopped every financial news network in its tracks, but it didn't. Instead, it was buried deep inside a routine SEC filing, released late on a Friday afternoon, the kind of disclosure most people never, ever read. In that filing, Goldman Sachs quietly revealed that they, along with a handful of other global giants, have executed a systematic exit from the very foundation of the world's financial system. Now, we aren't talking about a minor portfolio rebalancing. We're talking about a documented $847 billion dump of US Treasury bonds. I'm your SacroEconomics. My job is to investigate the quiet moves that the smart money makes while you're distracted by the daily headlines. And today, we are opening case file number 2, the bond reckoning. For 80 years, US Treasuries were the risk-free asset. They weren't just a safe investment, they were the very ground you walked on in the financial world. But as of 2026, that ground is moving. Goldman isn't just selling bonds. They are positioning for what I call a trust moment, a sudden, violent loss of confidence in a government's ability to manage its own debt. Think about it. While the official news tells you that economic growth is sturdy at 2.8%, the bond market is screaming a completely different story. Just recently, the 30-year bond yield spiked a 0.25 percentage point in a single day. Now, for those of you not in high finance, that's not a dip. That is a seismic event, an earthquake. Goldman Sachs sees the liquidity vacuum forming. They see a US debt that's rocketing towards $40 trillion, and they see interest expenses on that debt now exceeding the entire defense budget. They are quietly unbuckling their seatbelts, while the mainstream media is telling you to stay seated and enjoy the ride. But this is just the beginning. Next, we are going to open a much darker folder. We're going to look at why the risk-free return has become a return-free risk. I'll show you the foundation of sand the system is built on, and why the Fed's next move might be the one that finally breaks the bank. For 80 years, the global financial system was built on a single, unshakable belief. US Treasury bonds are risk-free. They were the ultimate collateral, the bedrock of every pension fund, every bank, and every insurance policy on Earth. But welcome to 2026. We have officially entered the era of the return-free risk. Now, Goldman Sachs isn't selling because they think the US government is going to vanish tomorrow. They are selling because they've done the math. They've realized that the equation of fiscal dominance has reached a point of no return. While the official news obsesses over the Fed's next interest rate cut, the bond market is performing a violent, behind-the-scenes repricing event. Here's the problem. When a government's deficit reaches 7% of GDP during a period of supposed growth, and the interest on that debt hits $1 trillion annually, the market stops asking if they will get paid. It starts asking what that payment will actually be worth. This is what I call the foundation of sand. Goldman sees that the Federal Reserve is caught in a fatal trap. If the Fed keeps rates high to fight inflation, the soaring interest payments bankrupt the government. But if the Fed cuts rates to save the government from those payments, inflation roars back to life and anyone holding those bonds gets wiped out by a catastrophic loss of purchasing power. So, what does Goldman Sachs do? They choose the third option. Strategic liquidation. They are quietly moving toward the exits because they know that in a world of infinite supply and shrinking demand, price eventually becomes an afterthought. And here's the trigger. When Japan, the single largest foreign holder of US debt, starts its own balance sheet reckoning and begins bringing its capital back home to Tokyo, the risk-free pillar of the financial system doesn't just crack, it crumbles. The smart money understands we are no longer in a normal market cycle. We are in a solvency event. They are trading paper promises for real assets, or as one trader put it, trading paper for real water, before the liquidity vacuum sucks the entire room dry. But where is all that capital going? And why is a quiet shift in Japan's central bank policy this black swan event that Goldman is actually terrified of? In the next section, we're going to meet the Bond Vigilantes and see how a $40 trillion debt ceiling is about to collide with a wall of global reality. In the world of high finance, price is just an opinion, but liquidity is a fact. And right now, the facts are turning ice cold. Goldman Sachs isn't just watching the US deficit, they are watching the Bond Vigilantes. The powerful global players who ultimately decide whether your country's debt is worth buying. For decades, the US had a silent partner in this game, the Bank of Japan. They kept trillions of dollars flowing into American bonds, creating artificial demand and keeping interest rates low. But that partner just walked out the door. With Japan finally raising its own interest rates for the first time in years, the famous carry trade is unwinding. Billions of dollars are being sucked out of the US Treasury market and sent flying back to Tokyo. This is the liquidity vacuum. It's not that people are suddenly angry at the dollar, it's simply that they found a better, safer deal back home. Think about the math here. when the largest foreign buyer of your debt stops buying, and the largest domestic banks, like Goldman, start selling, you're left with a mathematical nightmare. Infinite supply meeting zero demand. This is the moment when the smart money shifts from playing offense to playing defense. They see the balance sheet reckoning coming. They know that when the US Treasury holds its next massive bond auction and finds the room empty, the Fed will be forced into its final, most desperate move, yield curve control. In plain English, the Federal Reserve will print money to buy its own debt because nobody else will. This isn't a rescue. It is the intentional, systematic debasement of the currency to keep the government solvent. The vigilantes are no longer hiding in the shadows. They are here, and they are demanding a much higher risk premium for holding American debt. And as those yields climb, they act like a gravitational pull, dragging down every other part of the real economy with them. But how does an $847 billion dump in Manhattan affect a family in Ohio or a retiree in Florida? The next signal explains exactly why. We're going to look at the mortgage and bank trap. I'll show you why your local bank might be far more fragile than it looks, and reveal the hidden data that proves your safe bond ETF is actually the exit liquidity for Goldman's grand getaway. When Goldman Sachs dumps $847 billion in bonds, they aren't just moving numbers on a spreadsheet. They are triggering a chain reaction that ends at your front door. You see, the US 10-year Treasury is the master clock of global interest rates. When the giants sell, yields rise. And when yields rise, the cost of every car loan, credit card, and mortgage in the country follows. This is the mortgage trap. In early 2026, we are seeing the spread between bond yields and mortgage rates widen to historic levels. It's not just that houses are expensive, it's that the very mechanism of borrowing has become a liquidity vacuum. But there is a deeper, more silent danger: the bank trap. Your local bank is required by law to hold safe assets, mostly these same treasury bonds. But as Goldman exits, the market price of these bonds is undergoing a systematic repricing. On paper, these banks are sitting on billions in unrealized losses. As long as you keep your money in the bank, they're fine. But the moment liquidity dries up, those safe bonds become a weight that can pull the entire institution under. And here's the most cynical part of the investigation. And while the big banks are liquidating their positions, the marketing machine is shifted into high gear. They are telling retail investors that bonds are back and that 6% yields are a gift. They want you to be the exit liquidity. They need your 401k and your safe bond ETFs to buy the very debt they are desperate to get rid of. They are selling you a safe haven. That is actually a reversion to the mean event in disguise. In 2026, the risk isn't just that the market goes down. The risk is that the plumbing of the system, the banks and the bond market, stops working. We've seen the quiet updates to banking regulations. They are no longer preparing for bailouts with taxpayer money. They are preparing for bail-ins, where your deposits are used to keep the bank solvent during a liquidity vacuum. So, if the safest asset in history is now a trap, and your bank account is the collateral, where do you actually go? In our final chapter, The Survival Signal, I'm going to reveal the Debt-Free Ark. I'll show you why. Diversification is a dangerous lie in 2026, and give you the one tactical move to protect your family before the foundation finally cracks. We have followed the trail of the $847 billion dump. We've seen the fractures in the risk-free myth and exposed how your savings are being positioned as the exit liquidity for the world's largest banks. Now, as in SacroEconomics, I have to give you the final piece of the puzzle: how to build your own ark before the levee breaks. In a world of fiscal dominance where governments must choose between bankrupting themselves or devaluing your currency, the old rules of diversification are not just obsolete, they are a trap. For 40 years, the 60-40 portfolio was the gold standard. But in a liquidity vacuum, stocks and bonds often crash together. When the master clock, the 10-year Treasury, starts ticking erratically, everything priced in dollars begins to shake. Diversification across paper assets is just choosing which room of the Titanic you want to be in. The first pillar of the debt-free ark is the elimination of dollar-denominated liabilities. In a credit trap system, your debt is their leverage over your survival. Goldman Sachs has $847 billion in real water because they sold their paper promises. You must do the same with your personal balance sheet. But here is the detective's twist. Most people will tell you to rush into safe havens like gold or Bitcoin. But remember the lesson from case file number 1. In the first stage of a systematic repricing, even the best assets can drop 30 to 50% as the giants sell them to stay solvent. The ultimate asset in 2026 isn't just what you own, it is your time to wait. If you have no debt and high liquidity, a market crash isn't a tragedy, it's a clearance sale. The signal isn't to get rich quick, it's to stay liquid long. Goldman Sachs has made their move. The smart money is already on the Ark. You're being told the foundation is solid while the architects are already clearing out their desks. This was case file number 2. The bond market is the heart of the system, and that heart is skipping beats. But the bond dump is only part of a larger global shift. From the secret $2 trillion move by BlackRock to the final stages of the 7-stage collapse, the pattern is undeniable. Don't be the exit liquidity for a system that would not save you if the roles were reversed. Watch the signals, not the headlines. I'm opening case file number 3 tomorrow. Bill Gates is buying land, the 89B secret strategy. Why is the man who built the digital future suddenly obsessed with the dirt beneath your feet? The signal is loud, the ground is shifting. Subscribe now because once the vacuum hits, it's already too late.